One Up on Wall Street: How to Use What You Already Know to Make Money in the Market by Peter Lynch. Today's audio is about the book One Up on Wall Street by Peter Lynch. Peter Lynch is one of the world's most successful fund managers. How successful? Some say his contribution to the fund industry is akin to Michael Jordan's contribution to basketball. He managed the Magellan Fund, achieving an annual compound return of 29%, breaking the record for the mutual fund industry in the United States. In this book, Peter Lynch shares his entire philosophy and methods for selecting stocks, revealing the secrets that made him the most successful fund manager. Peter Lynch is especially known for his method of choosing 10 baggers, stocks that can increase tenfold in price over 10 years, also known as big winners. He elaborates on this method in detail in the book. Investment master Warren Buffett and Peter Lynch have always held mutual respect. Shortly after the book was published, Lynch received a call from Buffett, who said, "I just finished reading your book, and I loved it." Receiving such praise from Buffett indicates the book's remarkable value. In the following time, I will explain Peter Lynch's entire investment method in detail, breaking it down into 3 core principles. The first principle is finding 10 baggers, the second principle is identifying stocks to avoid, and the third principle is mastering the timing of buying and selling. Let's look at the first principle, finding 10 baggers, stocks that can increase more than tenfold in a relatively short period. During Peter Lynch's investment career, he placed great emphasis on identifying 10 baggers, possibly influenced by his first stock purchase experience. In his sophomore year of college, he bought his first stock, Flying Tiger Airlines, at $7 per share. In less than 2 years, the stock price rose to over $30. His first investment was a 5-bagger. This successful experience solidified his belief in continually searching for big winners throughout his decades-long investment career. In this book, Lynch boldly states that ordinary people, or amateur investors, have an advantage over professionals in finding 10 baggers. At first glance, this is a shocking viewpoint. In fact, Lynch's exact words are even more striking. 20 years of experience in the investment business has convinced me that any ordinary amateur investor can outperform the average performance of Wall Street professionals with just 3% of their intellect. For millions of ordinary people, this is truly an inspiring statement. But if it's only inspiring, that's not enough. Don't worry, in this book, Lynch explains in detail why he believes amateurs have an advantage in stock selection. A crucial reason is the lag in behavior among Wall Street professionals. Lynch points out that professionals usually wait until many renowned analysts recommend a stock and peers start buying heavily before they purchase it. For instance, a clothing company that went public in 1969 initially went unnoticed. 6 years after its IPO, it had opened 100 stores across the U.S., yet only one institutional investor had bought its stock. For years later, only 2 institutional investors had bought its stock. 14 years after its IPO, the company had hundreds of stores, with thriving business, and its stock price had risen 18 times. But only at this point did Wall Street start paying significant attention. 2 years later, when the stock price had increased 30 times, the institutions finally began to buy in heavily. Why do Wall Street professionals lag behind? Lynch believes it's because professionals usually don't dare to buy unknown small company stocks. He uses a vivid example: if you buy IBM stock and it drops, your clients and boss will ask, "What's wrong with IBM lately?" But if you buy an unknown motel company's stock and it drops, they'll ask, "What the hell were you thinking?" Because buying unknown small companies involves huge pressure, independent thinking is very difficult among professional investors. Therefore, Lynch says he strives to think like an amateur investor when selecting stocks. So, how should an amateur investor pick stock? Lynch has a famous saying, "The best place to find 10 baggers is close to home." If you can't find them there, go to the shopping mall, especially your workplace.
Let's imagine an example. Suppose someone who lives in rural America in the 1970s, grows their own food, and has no TV. How would they find 10 baggers? Maybe one day they get a stomachache and have to see a doctor, because country life gave them a peptic ulcer. This leads them to discover a 10-bagger, SmithKline-Beecham.at. The time, millions of Americans had heard of or used Tagamet, an effective and popular ulcer drug produced by SmithKline-Beecham, which became a 10-bagger. Finding 10 baggers seems simple, right? But don't get excited yet. The truth is, most people don't do this. Even Peter Lynch regrets missing out on big winners in his own industry. In 1977, Lynch was already working at Fidelity Investments, just when the mutual fund industry was booming, with several companies going public. One such company, Dreyfus, had a stock price of 40 cents in the 1970s and rose to nearly $40 by 1986, a 100-fold increase in 9 years. Despite working in the industry and being familiar with it, Lynch didn't buy the stock and missed out on a great opportunity.
People's reluctance to buy stocks in their own industry or those they are very familiar with seems common. Lynch describes this phenomenon. Generally, if you survey doctors, most likely only a small number of them have invested in pharmaceutical stocks, while the majority have invested in oil stocks. If you survey shoe store owners, most will have invested in airline stocks rather than shoe company stocks. Conversely, airline engineers may have invested more in shoe company stocks. This is a paradox. Stocks are like the grass on your lawn. People always think the grass on the other side is greener. So, to find 10 baggers from around you, you first need to overcome the misconception that the grass is greener on the other side, and then leverage your own advantages. How exactly should you do it? Lynch further classifies companies into 6 types: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Hearing 6 types might confuse you, but don't worry. The real potential for 10 baggers lies mainly in 3 types: fast growers, asset plays, and turnarounds. Moreover, different types of companies require different analytical methods. Let's focus on these 3 types of companies that are most likely to produce 10 baggers. First, let's look at fast growers, the hotbed of 10 baggers and Lynch's favorite type of company. These companies are usually newly established, small in scale, and have excellent growth potential, with an average annual growth rate of 20 to 25%. If you can pick good ones among them, you might find stocks that can increase 10-fold or even 100-fold. For amateur investors, this is highly beneficial because their account sizes are usually small. Finding just 1 or 2 such stocks can significantly boost their overall performance. However, it's important to note that these companies are small and not very strong, making them riskier than typical companies. You might step into a trap if you're not careful. The key to analyzing fast growers is their replicability, whether they can replicate their success in one location to other places. For example, Walmart in its expansion phase is a classic case. As the company continually opened new markets, profits grew rapidly, and so did the stock price. Lynch believes the trick to investing in such companies is to figure out when their growth period might end and sell the stock before the rapid growth phase concludes. Next, let's look at turnaround companies. Those that have been severely hit, are down but not out, and might even be close to bankruptcy. These companies are risky but can become big winners if they turn around. Investing in turnaround companies has the added benefit that their stock price movements are less correlated with the overall market. In the 1980s, the famous automaker Chrysler went through a severe crisis, almost bankrupt, but later recovered with government support. Lynch made a significant profit for the Magellan Fund by buying Chrysler stock. He began buying Chrysler stock in early 1982 at $6 per share, and it increased 15-fold in 5 years. Besides fast growers and turnarounds, there's another type that can produce 10 baggers: asset plays, companies with valuable assets unnoticed by Wall Street professionals. Lynch once visited a small cattle ranch in Florida, which seemed ordinary with some low bushes, cows grazing on the pasture, and about 20 employees. Where was the hidden asset? In the land itself. 10 years later, the land alone was worth over $200 per share. This is a typical example of an asset play. To recap Lynch's first investment principle, finding 10 baggers. Lynch believes that amateur investors have an advantage over professionals in finding big winners. 3 types of companies are most likely to become 10 baggers: fast growers, turnarounds, and asset plays. Now let's move on to the second investment principle, the stocks you should avoid. We just discussed how to identify the big winners in the market. You might feel very confident after listening to that part. However, it's important to remind you that in the stock market, besides those that can make you 10 times your investment, there are many traps that could result in significant losses. How can you avoid these pitfalls? Peter Lynch summarized his valuable lessons, and I've distilled the most crucial ones into 3 commandments. Peter Lynch's first commandment is, avoid hot stocks in hot industries. This may sound counterintuitive at first, like the saying even a pig can fly if it stands at the center of a whirlwind. Many people are eager to chase the trends. So why does Peter Lynch advise us to stay away from hot stocks in hot industries? The first reason is that hot stocks in hot industries are already receiving widespread attention. Every investor might talk about these stocks on their commute, meaning that there are very few new buyers left. With fewer new buyers, the possibility of the stock price falling increases. The second reason is that hot stocks are usually overvalued, and over time, bubbles will burst. For example, the dot-com bubble in 2000 saw many internet stocks plummet, with the Nasdaq index dropping by more than half in a short period, and many stock prices fell by 90%. The third reason is that hot industries attract a lot of capital, leading to overcompetition, which might result in none of the companies making money. For instance, in the 1960s, Xerox was a leading company in the copier industry and was the hottest stock in the U.S. market. Analysts were very optimistic about it. In 1972, when Xerox's stock price reached $170, analysts predicted it would continue to grow indefinitely. However, competitors like Canon, IBM, and Kodak entered the copier market, and soon there were 20 companies making copiers as good as Xerox's. Xerox's stock price eventually fell by over 80%. Peter Lynch's second commandment is, be wary of companies touted as the next big thing. The market often hypes companies as the next IBM, the next Intel, or the next Disney. Peter Lynch believes that these companies rarely become stars like their supposed models. In many industries, the first-place company often gets the majority of the market benefits, while the second place is significantly less profitable, not to mention those that are not even second place. Peter Lynch's third commandment is, beware of whispered stocks. If you've ever bought stocks, you might have encountered a friend telling you secretly about a great dark horse stock, urging you not to tell others. Unfortunately, these whispered stocks usually led to painful losses for Peter Lynch. For instance, the stock of National Healthcare Centers dropped from $14 per share to 50 cents, the stock of Sun World Airlines fell from $8 per share to 50 cents. Peter Lynch believes that these whispered stocks often tell a fantastic story, like a company's product can cure AIDS or solve oil shortages, but the company itself has no actual earnings, and most of these miraculous stories do not come true. Therefore, investing in such companies involves great risks and should be avoided. In this section, we learn 3 commandments: avoid hot stocks in hot industries, avoid companies hyped as the next big thing, and avoid whispered stocks. Each of these commandments represents costly lessons learned by Peter Lynch, and they are worth remembering. Now let's move on to Peter Lynch's third investment principle, mastering the timing of buying and selling. Let's first look at 2 wrong ways to trade stocks. Some investors habitually sell winners, meaning stocks with rising prices, but hold on to losers, meaning stocks with falling prices. Peter Lynch believes this strategy is foolish, like pulling out flowers and watering weeds. Conversely, is it better to sell losers and keep winners? Peter Lynch says this strategy is not much better. You might be confused now, wondering what to do if neither works. The reason these 2 strategies are bad is that they both rely primarily on current stock price changes for decision-making. So if you can't simply look at stock prices, what should you look at? Peter Lynch says you should analyze the company's fundamentals to see if the stock price is high or low relative to the fundamentals. If the price is overvalued, you should sell; if undervalued, you should buy. This is very similar to Warren Buffett's value investing strategy. Peter Lynch also made 2 additional points. There are two special periods when you might find particularly cheap stocks. The first period is at the end of the year when many investors sell losing stocks to reduce taxes, making it easy to find bargains. This relates to U.S. tax laws, which we won't expand on here. The second period is during market crashes or major downturns, which happen every few years, and these times often present great opportunities to buy cheap stocks. For example, in October 1987, the U.S. stock market crashed, and almost all stocks plummeted. Earlier, we mentioned that Peter Lynch missed out on a major winner in his industry, the stock of Dreyfus Corporation, which had risen significantly due to rapid business growth. During this market crash, Dreyfus Corporation stock fell along with the market, and at its lowest, the business was valued at almost just $1 per share, nearly free. This was clearly a great investment opportunity, and Peter Lynch seized it, buying the stock during the market downturn. A year later, its stock price had risen by 60%. Now let's discuss the timing for selling. Investors often make the mistake of selling a big winner too early. Let's look at one of Peter Lynch's failures. He sold Toys R Us too early, missing out on significant profits. Toys R Us was an excellent toy retail store that expanded rapidly in the U.S. in the 1980s. After thorough research, Peter Lynch bought many shares at about $1 per share. Shortly after, he read in the newspaper that a retail giant had bought 20% of Toys R Us, causing the stock price to rise. Peter Lynch thought that once this retail giant stopped buying, the stock price might drop, so he sold all his shares at around $5. However, by 1985, Toys R Us stock price had risen to $25 per share, a 25-fold increase. Unfortunately, Peter Lynch only made a 5-fold profit. In contrast, his colleague Peter Dross, who had recommended stock, held onto it and eventually achieved a 25-fold return. This shows that if you have long-term confidence in a company's development, you shouldn't sell its stock for short-term reasons, as you might not be able to buy it back at the same price. You might wonder if there is a way to sell stocks at their peak. Unfortunately, Peter Lynch says there's no such method. However, he shares his experience, advising that you should think about selling stocks the same way you think about buying them. When to sell a stock essentially comes down to 2 points. The first is to review the reason you bought the stock. If the initial reason no longer exists, it's time to sell. For example, if you bought a rapidly growing company's stock because it was expanding into new markets and its profits were growing quickly, you should sell when its growth slows down. Or, if you bought a turnaround company's stock because it was in crisis but had potential to recover, you should sell when the crisis is resolved and the stock has significantly increased. The second point is to compare the stock you hold with others in the market. If other stocks have a much better value, you should sell. We discussed the book Templeton's Way with Money, where John Templeton's thinking aligns with Peter Lynch's. When asked when to sell stocks, Templeton said, "When I find a better bargain elsewhere." This better bargain refers to the extent to which a stock's price is undervalued relative to its fundamentals.